Thank you very much, Matt. Can you hear me? Can everyone hear me? And I'm not sure if my screen can be seen. I'm hoping the presentation comes.
I can hear you, see you, and see your screen. So I'm
So
the only guy that isn't muted, so I'll tell you.
Excellent, great. So thank you very much for having me. Truly appreciate the opportunity to speak. It's always amazing to me to see how Marine Money is able to gather so many people to participate, generally speaking. But I think under these conditions, a credit and appreciate the opportunity to be involved. I'd like to spend my time today, as Matt's alluded to, talking about some alternative shipping investments, in particular investments that don't necessarily hinge on an appreciation of underlying asset values, but instead isolate earnings potentials, freight levels in particular. Now, I know right now freight levels are weak, and we are in fact in challenging times, but, and I'll steal a bit of what was said at the last panel, if people feel as though, and investors feel as though that we are in an underbuilt, pent-up demand scenario and want to express a view, there are alternative investments which will allow you to express your view in a very systematic and calculated way outside of mainstream shipping investing. I think a proper frame of reference is always a good place to start. The onset of the year was filled with people's attentions quickly being diverted towards a real problem in a global pandemic. While attention was focused on that and the subsequent destruction in demand that many anticipated would come, the market generally missed that we had one of the most positive quarters and positive starts to the year than we've seen in recent memory. Obviously, by people playing defense, they failed to ask obvious questions. Why was the market so strong? How was the reactions manifested in such a way? But more importantly, how could one be involved from a shipping-related perspective in participating in this uptick in earnings? From our perspective, it was quite obvious. It was a lack of ships. It was a lack of ships, a lack of ordering, a lack of vessels delivering over quite a long period of time, coupled with a sudden and unexpected inquiry from commodity movers for storage. What was viewed to be a relatively balanced market became quickly an inelastic market, and very quickly that manifested itself into much stronger rates. Now, if one were for a moment concede the fact that supply is at a favorable point, and there doesn't look to be a lot of incremental ships coming into the market, demand all of a sudden looks to be creeping back, and we're very quickly approaching pre-COVID levels. Now, you're not talking stellar year-on-year growth, but again, supply being relatively known and relatively balanced before the pandemic, coupled with the fact that demand is now approaching pre-COVID levels, one could start to build a credible argument that the type of positive volatility we saw at the beginning part of the year is a real possibility in the months ahead. In addition, not surprisingly, when you look at demand creeping back up to pre-COVID levels, vessel utilization is clearly improving. Now, you're not up to pre-COVID levels in terms of the number of liftings and the number of fixtures out there in the market, but it is a dramatic increase over recent months, and this trend is expected to continue as the world approaches some level of normalcy. So again, it is up to each individual to take a view, but if one is confident that supply is manageable and demand is improving, how does one invest in shipping to take advantage of the earnings potential of ships and a broader and more positive shipping environment? Certainly, shipping equities would be the cleanest and has always been viewed as the cleanest and most efficient way to express one's view that the market is improving. However, despite the fact that we've had very strong earnings, this hasn't been reflected in equity performance on a year-on-year basis as compared to 2019. Compare, however, the underlying earnings of the ships and what, for example, Navigate has been able to actually earn on assets that they're managing. It's a stark difference between how shipping equities have performed and how the underlying assets have yielded in terms of earnings. Now, this is largely because publicly related shipping companies, as we all know, are heavily focused on NAV, and there is the quote-unquote NAV lag that often presents itself when earnings are not properly reflected in underlying asset values. And publicly traded companies don't get credit, or at least from my perspective, our perspective, enough credit for the fact that the ships are yielding very positive earnings. So how can we isolate the earnings potentials of assets without necessarily taking on the underlying NAV risk? The simple answer to that question is time charters. Time charters provide the most efficient way to participate in a more positive earnings environment, assuming one has a view that we're approaching a more positive earnings environment without taking asset risk and being able to express their view in a pure play, systematic way. Look at the 1-year time charter rate reflected in this graph. This is the assessment from Clarkson's on what the 1-year average rate is across a multitude of tankers. Layer in now spot earnings. It is this differential between a relatively stagnant 1-year time charter rate and spot earnings which allows a premium to be built, taking a vessel in at a fixed rate and then putting it into the spot market and hopefully earning a premium. Navigate would have been able to deliver a premium of somewhere in the area of $3,400 a day during the life cycle of January 2014 to January 2020. However, not everyone will be able to deliver such a premium, and this is a bit where the Navigate alpha comes in, and certainly the alpha associated with any large commercial infrastructure. A large commercial infrastructure is required in order to deliver this type of premium. You need to have a global perspective, not just offices for the sake of having offices, but rather you need the information flow that comes into an organization to take a worldwide view on how commodities are flowing in order to be an early mover on identifying inflection points before they happen and solidify a time charter before the market starts to run away and owners reprice their ideas. You need to have a multitude of chartering reps sitting all over the world. Why? Because that will deliver the premium earnings required to maximize the ROI on that differential and that premium between the time chartered in rate and what you're reletting the ship in and the spot. These charterers need to be very close to the commodity movers in order to receive preferential treatment on cargoes and drive earnings higher. Most importantly, data, right? If one controls hundreds of ships, you're in the market every day, and you're in a multitude of different markets where you're able to properly categorize which way the market is starting to trend. If one has only a handful of ships, it becomes very difficult to calibrate what the inflection points are, where ton-mile demand is growing, and which specific asset class is going to benefit. At a very high level, one needs to partner with someone who has critical mass, has a global perspective, both in terms of information and for fixing windows, but most importantly has a proven track record of being in the time charter market and being able to deliver favorable deals that then could be applied to the spot market to generate a premium on a consistent basis. Our time charter investment platform does just that. Most importantly, it's based on market information. That is the essential part of our DNA, gathering as many data points as we can on an hourly, daily basis over a multitude of offices, so it's a 24-hour information feed. That will help us gauge the market timing on when is the opportune time to go out and time charter an asset. Then the vessel targeting is very important. What is the right vessel within a sector, within a segment, to identify that's going to maximize the earnings at any given point in time? Then a deal is discussed with investment partners, can be ship owners, can be commodity movers themselves, or third-party capital providers, to which Navigate will participate in the deal to align our interests, and then the asset is optimized by placing it within a pooling system where revenue is generated above market returns. Those earnings are then presented to an investment partner on a pro rata basis, and they are able to share in the premium that Navigate is able to generate over and above the time charter in rate. So why is it advantageous to look at TCs versus a multitude of other investment opportunities in shipping? Certainly, if one wants to acquire earnings and access to earnings, they can go and buy an asset and put that asset to work. However, everyone knows that it's very difficult to calibrate which asset to invest in. There's operational issues associated with owning a ship, and certainly exit is always opaque. Time charters with an investment partner like Navigate allows you to acquire pure play exposure, direct exposure to the segment that you want, and in particular, in particular sector within that segment that you want to gain access to. The earnings are correlated to what that vessel actually earns rather than a multitude of other ships. You will then be presented with regular deal flow where you can continue to add to your portfolio on time charters systematically as the market continues to improve over time. Every month, there's a settlement where the P&L of a particular deal is presented, so you know exactly where the deal stands. Most importantly, there's a guaranteed exit on each of these investments. The time charter is always due to end at a specific point in time, so there's no opportunities for the investment to run longer than you anticipate. But probably the most compelling reason is owners consistently provide charterers and then de facto the investment partner with a free option to extend the charter beyond the canceling date if market conditions warrant and if it's advantageous to do so. So for these reasons, time charter should always be viewed as a viable alternative, particularly for people who are growing more and more comfortable that we are approaching an inflection point where we are underbuilt and demand is pent up, which will be forced into the market. Thank you.
Jason, thanks very much. I have a number of questions, but I think what I'll do is direct people to you privately, if that's okay, because we're just running short on time. It's really cool to see the product. I mean, I think you've managed to take a lot of the negatives out of the kind of shipping investment profile, which is cool. But obviously, you're building that. You're kind of leveraging that, as you say, that incredible foundation of market information and relationships. So it's a very, very cool. So I will put anyone who would like to get in touch with Jason, please let me know. If you would like to attend the credit markets section, that is starting now. You need to log out of this and then log into the into that link to be there. And I want to thank you, Jason. I want to thank all the tanker panelists this morning. It was great morning so far, and I will see everyone over in the deal room, the credit room. Thanks, everybody.
Thank you very much.